Okay, this video is going to focus on comparative ratio analysis, which is the last part of financial ratios. So we've been looking at the different ratios, the liquidity ratio, the gearing ratio, the profitability ratios, as well as efficiency. But as I've been saying a lot in class, these ratios really mean nothing unless you compare them to something. And that comparison will happen either over different time periods. So for example, what was Qantas's net profit ratio for 2016 versus their net profit ratio for 2015. And really their 2016 net profit ratio doesn't mean anything unless there is some comparison made. And one of those comparisons can be over different time periods. It can also be against standards. So some industry bodies, for example, will publish relevant industry standards against which to compare. So for example, if we stick to Qantas, the airline industry might say that a good net profit ratio within their industry is 30%, and that's against the standard against which Qantas would measure their own net profit ratio. And similarly, comparison could also occur with similar businesses. So Qantas might compare itself to Emirates, for example, on some of its key ratios. So it's important to firstly be able to calculate those ratios and make some inferences about those ratios. But even more important really is the ability to compare, because without some sort of comparison, those ratios really are meaningless. So just to clarify the importance of comparative ratio analysis, as it says there, the comparison allows us to make some inferences about whether that particular ratio is good or bad, as we've said here. And you can't look at figures in isolation. Looking at them just in isolation might provide some distortion to those particular figures. They really are almost useless, or at least there's a degree of uselessness to them. And then other factors are at play as well in terms of what benefit do you actually get from calculating those ratios if you're not making any comparisons with them. Additionally, financial ratios can be used to track performance of the business over time. So, for example, what's our net profit ratio been for the last 5 years for this particular business? How has it improved? Or how has it deteriorated? And therefore, we need to focus on, for example, expenses. If it's our net profit ratio, why are our expenses increasing so much? Because that must be one of the reasons why our net profit ratio is deteriorating. Additionally, a business might look at past results to identify some trends. Okay, so what has been the trend in terms of our expense ratio? And additionally, it can be used, like I said before, to compare to industry or standard benchmarks. And those benchmarks might be provided by the peak body in that organisation, such as, like I said before, the Airlines Association, or it might in fact be released by a government body like the Australian Tax Office. Okay, so just to look at it in practical terms, I'm just going to use Qantas and United Airlines. Some of these figures are correct and some of them I've made up to a degree just to put some relevance to this comparative ratio analysis. So first comparison that can occur is over time periods. Now these figures are correct for Qantas's gearing levels. In 2014, their gearing level, remembering that 2014 was the financial year when they had a significant net loss, their gearing ratio at that time, so total debt to total equity, was 163%. So like we've been saying, anything over 100% is considered to be of concern. And that gearing ratio improved considerably into 2015 when it fell to 109%. So by comparing 2014 to 2015 in the context of just that one ratio, the gearing ratio, you could definitely say that Qantas's level of risk has reduced because of the significant reduction in their total or in their gearing ratio. Another comparison is against standards. The airline industry standard is to have a gearing level of around 92%. Now that's a very specific number, obviously, but that is a figure that's considered to be a benchmark within that industry. And you can see that given Qantas in 2014, they were nearly double that. So their gearing levels were far greater than most other businesses within that industry. They've managed to reduce that considerably in 2015 down to 109%, so they're getting closer towards what's considered to be a more industry benchmark. So that gives a really good idea about, what are other businesses in that industry doing in terms of gearing? And remembering that the higher the gearing ratio, it is considered that that business is at a higher level, is operating at a higher level of risk, because they've chosen to take on more debt in relation to equity. So therefore, Qantas in that example, against standards, is definitely of a higher risk, but at least that they have reduced the difference between their 2014 figure versus the standard and their 2015 figure versus the standard. The final comparison can occur with similar businesses. So for example, if we look at Qantas's gearing, 2015, 109%. If we then look at United Airlines' gearing level in 2015, their gearing level is about half that of Qantas. So they're only geared to about 50%. So again, if you compare Qantas's gearing ratio to another in the industry, they are taking on much greater risk than that other business in the industry. So those three examples give you an idea about the benefit of using comparative ratio analysis and putting all 7 ratios, if the same thing was done, putting them into some sort of context, because on their own, those figures really mean nothing. But when used as a comparative tool, they really give some good information that the business and both internal and external stakeholders can use within the business to make key decisions.